How to invest if you are self-employed, or if you are a 1099 sole proprietor or single member LLC or small business owner or entrepreneur, whatever it is you want to call yourself, you're in business for yourself. And in this video, we're going to talk a little bit about how to invest with an irregular income, with an unpredictable income, how to invest if you are self-employed. We're also going to talk a little bit about your self-employed retirement account options, solo 401k versus SEP IRA, simple IRA, traditional IRA versus Roth IRA. We're going to run through some of those as well. And then some logistics. How exactly are you going to do this? Where are you going to pull the money from? Which account are you going to use? All right, let's get to work. What's up, guys? I'm Kay Scholl. Welcome to another financial awareness video. So, your income isn't predictable. Well, welcome to the lifestyle of being someone that is self-employed. You're going to be dealing with this quite a bit, and hopefully this video will solve some of that income volatility issue. So pay attention. Maybe some months your income is up and things are going great, and maybe some months it's slow or it's down. So how are you going to do all of this? I've got a quick list. We're going to run through it here. Step one of how to invest with an irregular income, how to invest if you are self-employed. Step one is grind mode. You have to have money in order to be able to invest. And if you spend all of your money, then you're not going to be able to invest. So you have to be in grind mode at all times until you get yourself a little bit of cushion. What does grind mode mean? That means you're waking up early and working on your business. You're staying up late and working on your business. You're finding ways to do things more efficiently or at a lower cost so that you can increase your profit margin. You're learning how to leverage your time and do things a little bit faster and a little bit better. You're figuring out how to serve your customers as best as possible so that they naturally and organically refer more business to you. You have to be in grind mode so that you can outwork your competition. Your competition might be yourself. If you enjoy spending money, going on trips, and doing nice things, you have to be in grind mode so that you can not only afford that lifestyle and your business overhead expenses and your personal expenses, but all the extra stuff as well. You have to be in grind mode to outwork your competition, even if that competition is yourself, and you have to bring in more money than you make, which is the next point. You have to live below your means. You got to work hard and be in grind mode, and you have to live below your means. You can't be spending every penny that you make because you're self-employed. We're not really sure when the next check is going to come in or when the next invoice is going to be paid by the people that you just did the work for. So you have to live below your means, and you cannot spend every penny that comes in. And then next, when money does come in, you got to pay yourself first. You need an emergency fund for your personal expenses. You need an emergency fund for your business so that you could stay in business, right? And then you pay yourself first. You have to make sure that you pay yourself first so that way you could pay your own personal bills, make sure that the lights stay on over your head. And before you do anything else, you have to make sure that you pay yourself first. And then there is a difference between contributing into your retirement accounts versus investing into your retirement accounts. So grind mode, work super hard and make more money than you need, live below your means, pay yourself first, and then if your money is coming in very irregular, maybe you don't want to invest $200 a month or $500 a month to max out your Roth IRA. Maybe you get a big $3,000 chunk or a big $10,000 chunk in, and you want to just get it out of your checking account and you want to invest it right away. Well, you can contribute money on an annual basis or a lump sum basis, but that does not mean that you have to invest it. One of the best investing strategies that a lot of other people out there that are not self-employed like you and me, they are getting paid every other Friday, and they are dollar cost averaging into their 401k or into their TSP or into their 403b every single paycheck. So that means 24 or 26 times a year, they are investing money into the stock market. You can contribute money into your 401k, your solo 401k, your SEP IRA, when you get your taxes done around April, or if you delay them until October, or at the end of the year in December. You can make a lump sum contribution, but that does not mean that you have to invest all of that money. So how do you invest if you are self-employed? Well, when the money's good, save some for a rainy day, pay yourself first, and if you have a significant amount of extra money when things are going very, very well, make sure that you invest a chunk of that when the money is there and when the money is good. Okay, your self-employed retirement account options, what are they? We're going to run through a list here real quick. Traditional IRA versus Roth IRA. These are available to you whether you are self-employed or not. And I'll actually put a couple videos over my shoulders here because I've got more videos that talk about both the traditional IRA and the Roth IRA, whether you have a super high income or whether you are married filing jointly and have an household AGI of 125 or less. So I strongly recommend and encourage you to watch some of these videos depending on what your income level is at, to go a little bit deeper into the traditional IRA versus Roth IRA. In a nutshell and generically speaking, here's what you need to know. The traditional IRA is going to grow over time, tax deferred, and depending on how much money you make, you may or may not be able to deduct the amount of money you put into your traditional IRA. The Roth IRA is going to grow tax free, which is totally different. You put money in that has already been taxed, and over time, it will accumulate more and more money, both through capital gains and dividends based on how you have that money invested. And those gains over time are going to compound on each other, and they're going to grow tax-free. And then when you are older, unlike the traditional IRA, when you're older than 59 and a half, and you pull the money out of the account with a traditional IRA, that's when you owe taxes. You've deferred them. But with a Roth IRA, they've been growing tax-free. So as long as you pull them out after the age of 59 and a half, you can pull all of your money out tax-free. And then when you watch these videos, you'll learn a little bit more about some of the other implications of these two accounts as well. The simple IRA. This is one of your self-employed retirement account options that you could choose. A simple IRA is set up through your company, through your business, and the maximum that you could put in for 2021 is $13,500. Your company can match, and you could put like a 3% contribution in if you want, but the simple IRA doesn't have a Roth provision option to it. So 100% of what you put into your simple IRA will be a deduction against your self-employed income. Because this is a tax deduction, this money is going to grow tax deferred. So again, just like the traditional IRA, inside of a simple IRA, you put up to $13,500 into your simple IRA, and that money is going to grow tax deferred. And then when you are 59 and a half or older and you start to pull money out of the account, that's when you owe your taxes. With a SEP IRA, now we're going to get a little bit more complicated here, because the SEP IRA, you could open up and you could put 25% of your wages, not your K1 distributions, but 25% of your earned income, of your wages, which is the amount of money that you pay yourself from your business. You could put 25% into your SEP if you are an S Corp. If you are a sole proprietor or you're 1099, then you're capped at 20% of your wages. And if you're a sole proprietor, 1099, then it's 20% of basically what your Schedule C line 31 is, your net profit. You might want to watch a few of my other videos or a few other accounting videos to double check that it's based off of Schedule C line 31. So don't hold me to that, but you could put up to 20% of your earned income into your SEP IRA. Very similar to the simple, very similar to the traditional. That money in your SEP doesn't have a Roth provision to it. So that is a tax deduction against your gross income that you pay yourself. And that money in that SEP IRA is going to grow tax deferred. Now, I've got a really good video that compares the SEP IRA to the solo 401k, and I'll put it up on the screen here right now. Whenever you have the time, you're going to want to look into that video as well, because in my opinion, depending on how much revenue you're bringing in from your business, I think the solo 401k might be the better option between the solo 401k and the SEP IRA. With the solo 401k, you get pretty much the best of both worlds. You have basically a 401k. You have to think of yourself as a company, as an employer, and you have the same 401k privileges that other 401k plans have as well. So with a solo 401k, you could have a solo Roth 401k provision within your solo 401k plan. Why is that beneficial to you? Well, with a Roth IRA, if you are married filing jointly and you make anywhere from $198,000 to $208,000 of modified adjusted gross income, you're going to be phased out, and anything above $208,000 you can't contribute to a Roth IRA. If you are single, those same numbers are $125,000 to $140,000 of modified adjusted gross income, and you can't contribute to a Roth IRA. However, even if you make $208,000 or $300,000 a year, there are no income limitations to a solo Roth 401k. And because this operates very similar to a normal 401k, you could put in $19,500 into your solo 401k. But remember, you're self-employed, which means you've got you yourself and you've got your business. So based on the wages that you pay yourself, let's just say hypothetically you make $150,000 through your self-employed business, and you pay yourself a salary of $70,000 out of that $150,000. That means you got $80,000 of profit or K1 distributions and $70,000 of salary that you pay yourself. Well, if you contribute $19,500 into your solo 401k, that's going to reduce your $70,000 wage income. So there are some benefits of the solo 401k over the SEP IRA. It is a little bit more costly to run and operate a solo 401k. So that's why I say if your revenue is high enough, if you're making enough money, in my opinion, I think the solo 401k is the way you want to go. But the SEP IRA is much more cheap to operate and run and administer. It's just the overhead cost each year of the SEP IRA is a little bit different. Also with the solo 401k, there are borrowing provisions. With SEP, Simple, Traditional, and Roth, there are no borrowing provisions. So with the solo 401k, you could, not that you should, but you could borrow from it if you wanted to. And then this last one, this is an option that everybody can choose. This isn't special to being self-employed, but a non-qualified brokerage, just a normal investment account. That's something everybody can do. Everything else that's on this list is a qualified retirement account. It qualifies to receive certain tax treatments and certain tax benefits from the government. So a non-qualified plan, you will owe taxes each year based on capital gains and based on your dividends that you receive. However, the benefit is there are no limitations. You could put $300,000 into a non-qualified account and then pull $300,000 out the very next day. You can't do that with a solo 401k or any of these other options. There are some limitations both from an income perspective for some of these options and some contribution limits as well. $19,500 for the solo 401k. However, you also can match that 401k contribution, that solo 401k contribution from your company. So you can lower your wages that you pay yourself by up to $19,500, and your employer, which is yourself, can match certain contributions, and then you also can do additional profit sharing into your solo 401k. So there's pretty beneficial there. But like I said, all of these receive some degree of tax deferred or tax-free growth treatment, and that's why they qualify to receive certain tax benefits. A non-qualified account would be great if you wanted to have an account that you could liquidate before the age of 59 and a half for your early retirement goals. So these are all of your options. I've got several videos that go through a little bit more detail over some of these plans. This video was meant to be a little bit more big picture. Check out some of my other videos to see and learn more about what these options might mean for you. Okay, so let's talk some logistics. How exactly are you going to do this if you are wondering how to invest with an irregular income or how to invest if you are self-employed? Let's talk specifically about where this money should be coming from. Which account should you be using, and does it matter or does it change depending on what you're contributing to for your self-employed retirement accounts? And the answer is yes, it does matter. So we made a list here. Let's first talk personal versus business checking account. If you are self-employed, you need to segregate your funds both from your personal life and from your business. So you need to have a business checking account and a personal checking account. If anything that you're doing is for the benefit or for your business, that should be flowing in and out of your business checking account. And if it's going to the grocery store to buy yourself groceries for the week, that should be coming from your personal checking account. So from a retirement account standpoint, actually, hold on, before we jump into retirement accounts, so you should have your personal checking account and your personal savings account where your emergency fund is. Same thing with your business. You should have a business checking account, which is your operating account where money flows in and out of. You also need to have maybe 2 or 3 months worth of business reserves if you are self-employed. Have a personal emergency fund and have a business emergency fund if your income is irregular. You want to be able to continue to pay yourself a salary. You want to be able to keep paying your overhead to keep your business operational. So you need both an emergency fund for your personal expenses and an emergency fund to continue to operate your business. So let's run through a few examples. A moment ago, we talked about the traditional IRA and the Roth IRA. Those aren't special or unique to you if you are self-employed. Those are available to everybody. So when you run your taxes, you've got your Schedule C or you've got your S Corp if you're filing through an S Corp, and then all of that flows over to your 1040 as an individual, more than likely, whether you are married filing jointly or if you are single, it's going to flow over to your 1040. So for your traditional IRA and your Roth IRA, regardless of which one you choose, those contributions should come from your personal checking account because they are an individual retirement account that's not employer sponsored. It's not through your company, but your SEP IRA, your solo 401k, your simple IRA that we discussed a moment ago, all of those should flow from your business checking account because that is an employer sponsored plan. So you want to fund those accounts and make those contributions from your business checking account, not your personal checking account. And then we talked about this a minute ago, employer versus individual. We mentioned that the traditional IRA and the Roth IRA and that non-qualified just brokerage investment account, those are individual accounts, right? Those are accounts in your personal name, but an employer plan would be set up through your company business checking account. So you've got SEP IRA, solo 401k, and simple IRA. Those are employer sponsored. You just happen to be the employer because you are self-employed. You own the company. So your name is going to be both signing because you own the company and you are operating those employer retirement accounts, but you are also owning the business and you're an employee of the business as well. So you've got employer plans and you have individual plans. The employer plans, like I said, need to come from the business checking account where all of the business flows, and the individual accounts like the traditional IRA and Roth IRA, those should come from your personal checking account. And then from a risk and diversification standpoint, let's just talk through this real quick because most self-employed people are running and gunning through your business. You are working super hard and super diligently to operate your business as efficiently as possible. And most self-employed people that I have interacted with, they might know a thing or two about the stock market or they are learning more about the stock market. But if you are brand new because you've just been reinvesting back in your business and growing your business and you feel as someone who's self-employed who might have a successful business, you might feel like you can get a better rate of return on your money by reinvesting that money back into your business. And guess what? You are 100% correct, because you can control the outcome of your business. Arguably, you more than likely can get a better rate of return by reinvesting money back into your business. But whenever you are ready to slow that pedal down a little bit and you're ready to invest a little bit of money for your retirement, for your future, that could be through real estate, that could be through stock market assets like what we're talking about in this video. We're talking about retirement accounts. So when you are ready and when that happens, in my opinion, working with a lot of small business owners and people that are self-employed, you don't want to have to worry about your business and worry about your stock market stuff. So if you are newer to investing as someone who is self-employed, take your time. Go slow. You don't have to jump right into the riskiest of investments through the stock market when you are first getting started. So from a risk and diversification standpoint, take an investor profile, take an investor risk tolerance test to find out where you land as a stock market investor. And then once you arrive at your risk tolerance, and I'll actually link a video right here about how aggressive should you be, as a great video. I will also talk a little bit today about maybe not taking the most riskiest of investments with individual stocks, right? If you are so focused on growing your business, you might want to be in a more balanced or conservative stock market portfolio until you learn more about what the stock market is and how it moves. Don't just jump right in to the most aggressive position, right? You've got individual stocks and you've got things called mutual funds and ETFs. Each of these have some degree of operating expense ratio of how expensive it is to own an ETF or to own a mutual fund. As you are getting started, do your research. And if you're not sure really where to start, I would tell you, don't jump right into individual stocks. That is a little bit more concentrating into one company and not as diversified. So if you are just getting started and you are someone that is self-employed, I would say don't jump right into individual stocks and maybe just choose a simple target date fund. If you are 30 years old in the year 2020 and you think you want to retire when you are 60, then you should consider a 2050 target date fund, right? 2020 plus 30 years. If you're 30 years old in 2020, which means you're 31 years old right now in 2021, then you should consider, just to get started, a simple target date fund. That is something that takes the risk completely off your hands. There is risk involved, but essentially it's riskier when you're younger, and as you get closer and closer to your retirement age, that target date fund is slowly over time getting more and more balanced and more conservative. So if you are just getting your feet wet and just starting your Roth IRA open, or just starting your solo 401k or your SEP IRA or simple IRA through your self-employed small business, don't get overcomplicated. Don't make it too complex. Keep it simple. Start off for a little bit with a simple target date fund, or make the contribution into your retirement account, but don't invest it just yet. Do a little bit of homework, do a little bit of research. And then as you mature in your investing career, you will tend to take a little bit more risk, maybe with individual stocks, maybe with more aggressive ETFs or mutual funds based on certain sectors or industries that you want to invest in. So should you invest for your retirement? Yes, absolutely. Can you get a better rate of return by reinvesting back into your business? Probably, but you make money by concentrating and you keep money by diversifying. So concentrate into your business, because that's where you're going to make most of your money, by concentrating into that service or that product that you sell as a small business owner, but you keep your money by diversifying it, by investing it in maybe a non-retirement account or a retirement account in some sort of diversified manner. And as you mature in time and as you mature throughout your investing career, you will more than likely have a little bit more of an appetite to take some risk. Okay, so what are my thoughts? Well, I'll share them with you right now. If you are self-employed and you're wondering how to invest with an irregular income, or how to invest if you are self-employed, my thought number one is you must be organized. You can't be just flying through your business, having money come in, having money go out, and not really accounting for it. You have to be organized in what your plan of attack is and how you plan to invest. Also, have a plan. Check out this video right here about how to make your own retirement plan in like 6 steps. It's not as hard as you think. It's super easy. Have a plan for what you want to do in terms of your retirement, and have a plan for what you plan to do with which account you're going to open and with how much you're going to contribute into your retirement account compared to reinvesting back into your business or paying down debt or saving cash or whatever your financial plan or your financial goal is at whatever stage in life you're at. Just make sure that you have a plan, and then be intentional. Be intentional about where you choose to deploy your time. Be intentional about where you decide to employ your hard-earned dollars. If there's a piece of equipment that you need to buy to help operate your business, think through how much should you use to purchase that piece of equipment, and how much do you have left over, or how much can you afford to invest in your retirement. Make sure that you are intentional about what you're doing, and you're not just floating through each week, floating through each month or each quarter in your business. Be intentional about what it is that you are doing and dedicate time. Instead of working in your business, in the day-to-day grind, make sure that you take time to work on your business. You're watching this video already. Hopefully you're watching a few of my other videos as well for self-employed people. Take the time to work on your business instead of working in your business. It will really pay off in the long run. And then taxes. A lot of the things that we talked about today in terms of retirement accounts for those of you that are self-employed that are watching this video can be a tax deduction for you against your business, whether you do a solo 401k pre-tax contribution or a solo Roth 401k contribution that maybe doesn't have a tax deduction to it. So make sure that you are aware of the tax implications of what it is that you plan to do, whether it's a traditional or Roth IRA that you're going to fund and contribute to from your personal accounts, or whether it's one of those self-employed retirement accounts that you could open up, the SEP, the Simple, or the Solo 401k. Make sure you know whichever one of those you choose, what are the tax implications? What will that mean to me? What will that mean to you? How much self-employment tax will you have to pay? So be intentional, be organized, have a plan, and make sure you know what the tax implications are depending on what it is you're going to choose. Hey, if you are self-employed and you're not sure if you should contribute and open up a SEP IRA or a solo 401k, check out this video right here. If you have any questions for me, let me know in the comments down below. I appreciate your time. See you in the next one.